Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, April 22nd, 2010. Let's start with the euro-dollar pair, where we saw the green bond markets continuing to be routed, with the latest run set off by news that the EU was revising up its estimate of the 2009 Greek fiscal deficit. Eurostat showed that Greece's budget deficit last year reached 13.6% of GDP and could be revised higher still, which was sharply higher than the 12.7% estimated by the Greek government late last year. Illustrating just how poor investor sentiment has become, the cost of insuring Greek government bonds through credit default swaps surged Thursday to 620 basis points. We also had a Moody's downgrade of Greece today, adding to the euro's woes, as well as a sharp rise in the spreads between Greek and German 10-year bonds. All that resulted in serious pressure on the euro-dollar pair, with the euro sliding from an overnight high around 1.3420 to set a low in the New York morning trading around 132.50. That extended the decline in the pair we had seen all week, plus the end of last week where we had started our slide around 1.3670. Today's low pushed below what we saw on April 8th when we rallied here following the announcement of the IMF EU deal for 45 billion euros. But today we breached that level shortly, though it was rejected, and we did have a bit of a counter rally in the euro following this test. The EU, the IMF, and Greece continued their second day of meetings on a debt backstop plan. But overall, today's developments increased risk aversion across financial markets, with global equities sliding sharply, especially overnight and at the beginning of the New York trading session. Financial aid for Greece could be delivered immediately if the country asks for help, the Eurozone's economy commissioner Olli Rehn said today, which did help the euro cement this afternoon recovery. The sell-off of Greek bonds and pressure that the euro is facing, as well as the overall risk aversion, helped the euro-yen pair to move in favor of the yen during overnight trading. Though we did hit the support around 123.30, which was close to our low on April 18th, and we did see a bit of a counter rally during the New York afternoon session. With all the focus on Greece, we did overlook a pretty good fundamental report from the Eurozone, which was the preliminary version of manufacturing and services PMI. The manufacturing PMI for April rose to 57.5, while services rose to 55.5. Manufacturing continued to lead the upturn, recording the fastest growth of production since June 2000, and it's the 9th consecutive month we've been above the 50 level, separating expansion from contraction. Turning to the pound-dollar pair, we see here an overnight, the pound was swept up in the risk aversion and slid from its high around 1.5470 down to support around 1.5350, which held rather nicely. We tested it twice during New York trading. The pound had a slew of reports come out today. While we did have weaker than expected retail sales, they were still positive, and we did see a better than expected reading on mortgage approvals. So that helped to give the pound some support following this slide. The 153.50 level is an important level, as if we go back, it held as support in last week's trading, and though we dipped below it to start this week, once we moved above it again, we have used it as support now twice. So if 1.5350 can hold, that's a bullish sign for the pound-dollar pair, but if we fall below, then we could look to retest the 1.52 area. Comparing the euro against the pound, meanwhile, we see that during this week the pound has strengthened significantly against the euro and has picked up the pace of its increase over the last two sessions. We broke below this 0.8750 level, and we found support around 0.8630. If we zoom this pair out, we have a second level of support that was broken in this week's trading, here around 0.87, and as we can tell, that helped to further break us out of this consolidation we had seen throughout the middle part of April. Now let's take a look at the UK fundamental data I had mentioned. UK retail sales rose for a second month in March on gains at department stores, a sign that the economic recovery is gathering strength. Sales were up 0.4% from February, when they increased 2.5%. A second report showed that the number of loans for house purchases granted rose to 52,000 from a 9-month low of 48,000 in February. That is a positive development for the UK housing sector. We also had data showing net public sector borrowing was £23.5 billion in March, which is the largest amount since the monthly series started in January 1993. So we had already seen how we had a rather strong risk aversion in the currency markets overnight. Here we're taking a look at gold prices, and we see that we slid sharply overnight, falling to 1,130 from 1,149 high to low. It's interesting to see that gold is being sold off during this environment of safe haven, especially as we saw a rather sharp sell-off last Friday following the SEC charges being filed against Goldman Sachs. So again, it seems that the safety of U.S. Treasuries seem to be the favored safe haven destination for investors and traders. Still, we did see a pretty good counter rally in gold prices following our overnight slide, as we did have U.S. equities pare some of their opening losses. That helped riskier assets linked to commodity currencies such as Australian dollar to rally in the afternoon. Here we're looking at the Aussie-US dollar pair, and in yesterday's session we saw the start of a decline which was extended in today's risk aversion environment. However, we did bounce up off the 0.9225 level, which had acted as support last week twice, and we counter-rallied, though we do have a downward sloping level of resistance right now acting as our next important level. Taking a look at a second commodity currency pair, here is the US dollar Canadian dollar, and we see that overnight we moved in favor of the greenback as we reached a high of above parity at 1.0037. That was also coincided with our 200 period moving average in the 1 hour time frame, and from there we reversed some of our gains and moved back down below parity. So following some volatile price action within the last 5 sessions, it seems that the last 2 sessions we're seeing a little bit of consolidation in the pair. The dollar yen, meanwhile, which was weaker overnight, rallied as well, and in New York afternoon trading hit a new intraday high, and as we film this video around 3:50 p.m. Eastern, we move above the 93.50 level. By this point, U.S. equities, the main indexes, had all moved to the positive following our sharp decline to start the day. So risk appetite had turned in the New York session, which helped to boost the dollar-yen pair as well as helped to recover in some of the other pairs we had seen earlier. The U.S. also had several fundamental releases that came out, though for the most part they were overshadowed by the themes of risk aversion and risk sentiment. Producer prices in the U.S. in the month of March rose 0.7%, which made up for the 0.6% decline in prices we saw in February. The 0.7 figure was higher than expectations, but if we take a closer look, we see that the core PPI, which excludes energy and food prices, grew a tame 0.1%. The cost of food jumped 2.4% in March, the most since January 1984, and was responsible for most of the headline increase. The number of Americans filing first-time claims for unemployment benefits dropped by 24,000 to 456,000 in the week ended April 17th. Also, the number of people continuing to receive jobless benefits as well as those getting extended benefits declined as well. The data helps to stop a recent rise in claims and could return the path of jobless claims to the downward trend we had seen since claims peaked around March and April of 2009. In a third important release, we had existing home sales show a stronger than expected 6.8% increase on the month in March, which climbed to an annual rate of 5.35 million sales from 5.01 million in February. Buyers responded to the home buyer tax credit and favorable affordability conditions, which boosted sales. A separate report, however, did show that housing prices fell 0.2% on the month in February, which follows decreases both in December and January. However, the February reading of 0.2% was much smaller decline than the previous 2 months, and it looks like we may be headed back into positive increases in housing prices next month. So that will do it for our fundamental and market highlights, and let's take a look at what we can expect to finish off the week from the fundamentals. Tonight at 9:30 p.m. Australia posts its import prices, which will be followed by a speech by the RBA governor. Overnight, Japan posts its All-Industrial Activity Index, which is followed by the Germany's IFO Business Climate Index and the UK first quarter GDP figures. That is followed in the Eurozone with industrial new orders. Tomorrow, 2 important releases from Canada, including consumer prices and retail sales. And from the US, we get data on durable goods orders as well as new home sales. So that will wrap up this broadcast. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.